Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we are here for Jobs Day. Reviewing a lot of the sell side research, it seems like it's probably early to see the effects of federal downsizing that everyone's been talking about with Doge and so forth. The general view, in fact, is that the federal government layoffs are likely to show up in the March release, published next month. But with that headwind on the horizon, the big question here is going to be what momentum are we taking into this tricky situation in the labor market and the economy? Here with us to discuss these matters, we have Jose Torres, a senior economist with Interactive Brokers, formerly worked for FDIC and the BLS. Also here today, my colleague Allison Schrager, Bloomberg columnist, a senior fellow with the Manhattan Institute, and author. Guys, the Bloomberg consensus today is that we're going to see a plus 160K on payrolls, which would be a little bit better than the previous month. Bloomberg Economics has sort of an outside view that it could be particularly soft. They have their rationale. They're looking for just a plus 65K. So that's something to look out for. Again, the consensus, though, is that this will translate into flat unemployment rate, so 4% on U3. Jose Torres, what do you make of this labor market? How should we be thinking about this with the headwinds coming up from the federal government downsizing?
Well, Jonathan, thanks for having me. Great to be here. I think the uncertainty itself of the government budget reductions, as well as the trade policy and the immigration restrictions, I think that itself is really slowing down the economy as business executives sort of wait and see what the path ahead is going to look like before they start adding a lot of labor. Our prediction markets here at Interactive Brokers also expect a softer number. We're at around 145. My personal estimate is at 115. So I would agree that we are going to get a softer number in a few minutes. We saw the ADP report a few days ago, really soft. 4 out of 10 sectors lost jobs. And it looks like the economy is slowing. But we also last year in the summer, we saw a glimpse of that as well. We saw some payrolls come in soft in July and August. And then, that was part of the rationale for the Fed's supersized 50 basis point reduction. So, we got to see if this slowdown is going to be more of a prolonged one or just a little pause in the economic cycle.
Yeah, Allison, what are you going to be looking for this month in this tricky report that may be sort of hitting kind of before an inflection point? How do you read a report like this one?
Well, I think, as I said, the thing about a Trump presidency is news gets stale super fast, and I think this report, while it might not be strong, is also going to be an artifact of when we were so naive and thought tariffs were just talk and it was going to be great and deregulation and tax cuts. So, I think, for me, it will be like, hey, what could have been, or maybe what will be in the future, but not where we are right now.
Yeah. Jose, we have about a minute to go here, so I'll cut you off probably mid sentence. But, a talking point that I keep hearing from the administration, perhaps a talking point that's meant to lower expectations a little bit, is this idea that this economy is detoxing from big fiscal, right? Do you buy into that? And what is that sort of, fiscal cliff, if you can call it that? What does that look like to you?
Jonathan, I think the administration is in a little bit of a pickle because this administration and these characters, they love growth. And from what we can see in history, austerity measures don't promote growth that much, So are we going to have some stock market volatility? Or are we going to have some economic turbulence because of the reduction in government spending? I think so, especially because we've been so conditioned to run large deficits for a few decades.
Yeah. All right. Well, we've got a number coming to you in just about 10 seconds. Again, we're going into this. The survey says that it's supposed to come in at plus 160K on your non-farm payrolls. It comes in at plus 151K, so pretty darn close. However, I'll draw your attention to the fact that the unemployment rate does tick up. It ticks up to 4.1%. That was versus 4.1% the previous month and an expected 4% in the survey. Average hourly earnings coming in at plus 0.3% seasonally adjusted month on month. That does bring your year-on-year change in average hourly earnings to plus 4%. A few other things to bring to your attention. Average weekly hours, all employees holding steady at 34.1. I'll remind you that the work week has been getting shorter, but comparing this month's report to last month's report, we're basically flat. I'll tick off the last two line items here. Labor force participation rate, interesting, ticking down in a meaningful way, 62.4% versus a prior 62.6%. This again bucking expectations. Golly, this might prove to be interesting as well. We see the underemployment rate ticking up to 8%. I'll take you to some market reaction real quickly before I turn it over to you all. Here is the yield on your 10-year Treasury note. We were trading down a little bit going into the number, and you do see a knee-jerk reaction up in the 10-year Treasury note, but it's really just so small, and you take that in an environment of pretty noteworthy volatility in fixed income markets in recent weeks. It's kind of unremarkable market taking this number in stride, at least for now. Jose Torres, what do you make of these numbers coming at us right here?
Yeah, well, I think it's a little soft, but a lot better than feared. Like you said, there were some expectations that expected a number below 100,000, which psychologically is particularly damaging. Equities have been at a really pivotal point. The S&P 500 was trading right near its 200-day moving average for a few days. Yeah. So, today we're seeing the equity market sort of breathe a sigh of relief and creating some space away from its 200-day moving average, at least for now.
Yeah, Allison, what do you make of it? And again, help folks put this in context a little bit here, because we do get essentially a fine report this month, but we know that there are headwinds ahead. So how should we be thinking about this?
Yeah, as I said, I think, we got to buckle up for the next 4 years. That, data that's a month old no longer really tells us much anymore, because, things move very fast in this environment. And in fact, a month from now, when we're looking at these numbers, we could be like, remember we were worried about Doge? Well, here are those numbers. We don't care about this anymore. I mean, you don't know what to expect because anything's on the table. I mean, especially with the fact that there were some hints yesterday in the meeting that Trump is sort of like trying to rein in some of these layoffs. There might be legal challenges to it. And we still don't know how much the extent of all these layoffs is even going to have, how large they are relative to the labor market, whether or not they affect contractors, which is a much bigger segment of government employment. So I think, as I said, it sort of raises a challenge. But I think Jose makes a really good point that I think going forward, I'm almost like less concerned about the direct impact of Doge on the labor market than the general uncertainty that it's going to have a bigger impact on hiring across the board in the private sector.
Right, exactly. Let me quickly take you all through the decomposition for this number, so you can see on sort of a sector by sector basis where the growth is coming from. So again, we're looking at a top line figure of plus 151. I'll just go down through each line item, and the two of you feel free to jump in if anything jumps out at you. Mining and logging, very small category, flips to slightly positive from slightly negative. Interesting. Construction, which includes a lot of things beyond just residential, but we do see a pretty meaningfully positive contribution from construction, plus 19,000 jobs to payrolls. It had been essentially flat. We can dig under the hood there if you like. I remain sort of nervous about this because it does include residential construction, and it seems like there are a lot of headwinds to residential constructions with mortgage rates staying where they are. Manufacturing flips to slightly positive in the month. Trade, transportation, and utilities sort of chugging along. Information doing fine, plus 5,000 jobs. Financial activities chugging along. Professional and business services, I think this is kind of interesting. It's a bit of a misnomer when people suggest that it's just white collar work, but it does have a lot of white collar workers in this category, and it's a category that has in some ways been soft even when other parts of the labor market were strong. We're flat in the month of February, so nothing particularly remarkable there.
Can I jump in here, Jonathan?
Yeah, please do, Jose.
Yeah, so you look at that big number in education and health services. This is another jobs report, yet another one with a non-cyclical tilt. Roughly half of your job gains are coming from this one category, which is non-cyclical. So
yeah, that's a big contribution. Yeah.
Yeah, it's similar to the reports we've been getting, the past few months, where we have the hiring rate is not that high. We don't have robust hiring, but we don't have a lot of labor trimming either. So not much hiring, not much firing. Leisure and hospitality, huge discretionary sector, back-to-back losses. Also a sector where a lot of immigrants that come in gravitate towards that sector. So really watching that closely.
Did I lose you?
No, I'm here. I'm here. That was it. I'm really watching that closely. So I was going to say something else, but I figured that was probably fine to stop there.
No, that's a really great point. So do you think what we're seeing from leisure hospitality is it could be presumably related to the availability of labor, or do you think it's more demand side, Jose, if you had to guess, or too hard to say?
I would say it's a mix of the two. When we consider that consumer spending has been slowing down, the PCE report we got for January, as well as the retail sales report for the same month, were particularly negative. The declines were the sharpest in 22 months on retail sales and 47 months on PCE. Now, is that consumer spending deceleration going to continue? I think what Allison alluded to earlier, the uncertainty of the economic landscape, companies increasing their prices already ahead of potential disturbances. To the extent that continues, I think that's a risk to the economy. But final point here for now is that last year we saw many months where households were managing their budgets like light switches. So in one month, they'd spend aggressively only to retreat significantly, replenish those funds, those reserves, pay down some debt perhaps, only to come back the next month. So I think February consumer spending numbers are going to be pivotal. Against that backdrop, Atlanta GDP now has been particularly negative. So if the consumer doesn't come back soon, we're going to have some economic turbulence, I think.
Yeah. Okay. Yeah. And just to complete this thought, I did put up the breakdown of just leisure and hospitality so people can see where this is coming from. Arts, entertainment, and recreation still marginally positive, but accommodation and food services, a big drag here. Accommodations actually slightly positive. the drag presumably coming from food services and drinking places, which I think is so interesting. There was almost a behavioral change during the post-pandemic years where people were just spending a lot more money on dining out. I think there was a narrative that people were spending a lot more money on sort of services in general. They called it like revenge spending. People who didn't get the opportunity to dine out in the very early days of the pandemic just sort of started going bananas at the steakhouse and so forth. But that may be fading. And as you say, Jose, this is one of these areas. Maybe it's kind of a bellwether for the way people are thinking about other forms of discretionary spending here. So we'll have to watch that closely. Allison, I wonder, if this labor market can stay on its feet, what needs to carry it here? Because as Jose points out, a lot of labor market or I should say a lot of jobs growth in this report, as has been the case for a long time, coming from like healthcare, right? Healthcare, famously a sector that just needed to get staffed up. They needed nurses. This is sort of an acyclical factor. Who knows how long we can depend on it? What is it going to take to make somebody like you feel comfortable that this labor market is in a sustainable place?
I feel like it is. Well, I mean, I don't know about this month. I said data gets stale fast, but
right.
I think based on this labor market, it is in a pretty good place. I mean, Jose points out some sources of weakness, but I mean, I think the move to healthcare and education is largely a structural shift, and our economy is undergoing, moving more and more into services. So that's not necessarily a bad thing. It's not a temporary thing. It's been going for a long time, and it's still a huge growing part of the economy. Again, I mean, we might be going through another structural shift out of, an era of very large government to more private sector, and that might cause some dislocations in the short term. But if the administration just chooses to get out of its own way and just focuses on, deregulation and tax cuts, yeah, I could feel pretty good about this. It's just I think so much of the risk now is actually, for me, really policy oriented more than the economy. The economy is in pretty good shape. I mean, I think a lot of what we're seeing, the volatility, is the fact people are nervous about a couple of things. People are a little nervous about aspects of the stock market. And I think that's why we're seeing certain stocks falling more than others. But, there's nothing like inherently unhealthy. It's really, as I said, just a lot of policy risk right now.
Okay. All right.
If I could add to that.
Yeah, go ahead. Jump in there, Jose.
Yeah. Allison, I think also, to your point on the stock market, folks look at their portfolios and they were used to seeing it go up so much all the time, 2023, 2024, both years, roughly 25% returns each, and now they see their portfolios a little more turbulent, the numbers going up and down a little faster, volatility coming in. And Jonathan, at the steakhouse, now they're taking it more easy, perhaps.
Right.
So,
right.
Yeah, I was looking at the S&P yesterday, and it's still up 13% from last year. I mean, that's really high. I mean, S&P usually returns 8% a year. So, I mean, anyway, it's kind of horrifying what's happened to it since the last couple of months. It's 13%, still pretty good. Just, less good than it needs to be.
Yeah. Well, let me try and bring a couple of ideas together here. Allison, you lay out an interesting possibility. I think that there are maybe some things to look forward to, maybe even as soon as later in the year, right? So the Trump administration comes in here. We're dealing right now with the policies that are the most challenging ones for the markets, and maybe even the labor markets to absorb, namely tariffs. But later in the year, markets folks are sort of looking forward to potentially tax cuts, which, say what you will about fiscal concerns. I personally have a lot of fiscal concerns around the tax cut agenda, but in the near term, probably pro growth, and then add to that the possibility of deregulation. People tend to think that is pro growth. But here's my question: we used to talk a lot about inertia in the labor market, right? You'll recall that last year we spent a lot of time talking about the Sahm rule, the idea that once unemployment starts drifting up, it tends to continue to go to drift up, because when a few people lose their jobs, they probably cut back on discretionary spending, and this can become something of a cycle, a negative feedback loop in the economy. How do we balance the fact that there is this inertia in the labor market with the idea that, well, but the administration does have these other buttons that it can push in the form of tax cuts and deregulation that can maybe act as a sort of Trump put on the stock market and maybe even the labor market? How do you think about that confluence of factors, Allison?
Well, I mean, I think really what the confluence of factors is just adding to uncertainty. I mean, I think, and that suggests, as I said, the labor market, might even sort of be even more persistent because people just won't want to make it decisions either way. They might not be laying people off, but because there could be growth ahead and the labor market could get even tighter, but they also don't want to hire a lot of people either. So I think we're going to sort of hopefully see, and it's not bad. The labor market's not in a bad spot. I'd be quite happy to stick around 4% unemployment. And so I think, sort of, as I said, if there's just one thing we can take away, is it's just a very, very uncertain environment. And that tends to mean that people just don't make decisions either way.
Right. All right. Well, let's talk about some of this uncertainty a little bit. Allison and I on these live reacts have talked a lot about tariffs. Allison, I think you'd agree that we have a little bit more information on what the tariff policies actually are.
I still don't know.
You still don't know?
Can I jump in?
Yeah, go ahead. Go ahead, Jose.
Yeah, the tariff policy, the immigration policy, the austerity measures, those three weigh on growth. So I think what the administration is trying to do is maybe pace themselves with those policies, while the policies of lighter taxation, milder regulatory regime, those policies are growth positive. So I think the administration is trying to weigh those two. If they move too fast on trade, then they don't give time for those growth tailwinds to come in. So I think it's a tough balancing act. And to Allison's point, a lot of uncertainty.
I'm less concerned about austerity. I mean, I think because usually when you see austerity, it's usually like in some sort of debt situation where they're really having to pull back on spending. And if the austerity is, as I said, paired again with tax cuts, which I guess makes it so like not really quite as austere in deregulation, then that could be okay. As that it could just represent a shift from a larger government to a bigger private sector, which will definitely cause some dislocations along the way, but does have some advantages depending on who you think is more productive.
Yeah.
But
a big question about the whole tariff thing is I've been sort of thinking about it in terms of these three buckets, right? You've got sort of the negotiating tactic tariffs, or what some people think are the negotiating tactic tariffs. I kind of put the North America tariffs, Canada, Mexico, in that bucket, right? At the other extreme, you seem to have the China trade war. I'm basically assuming, and I think a lot of people on Wall Street are assuming, that these are kind of here to stay. They're not necessarily just negotiating tactics. And then you have strategies sort of oriented towards Europe, which seem to be somewhere in the middle. I guess my question is, do you think that framing is right, Jose? And B, do you think people actually making important decisions about how to allocate capital for their business are thinking about it in that clear of a way, or are they just like lost in this total fog of uncertainty?
They are lost in this total fog of uncertainty, but the labor market is still adding jobs, albeit the hiring rate is slow. Businesses are still, they have strong balance sheets. We talked a lot about the shift from the government to the private sector under this administration, the potential shift. One shift we've seen in the past few decades is the private sector balance sheets, not just corporates, but also individuals, are a lot stronger than they were, say, pre-2008. So that really gives the consumer and employers alike a lot more endurance going forward. But the uncertainty is a cloud, and particularly for consumer spending, we spoke a little bit earlier about the wealth effect. That's more oriented towards the middle and higher end consumers, but at the middle to lower end, their focus is primarily, do I have job security, and how far is my dollar taking me in terms of inflation? And those two things have been particularly cloudy lately, as considering the hard data from retail sales PCE, but also the soft data from consumer sentiment confidence.
Right.
Yeah, it's interesting. Like you hear, at least on TV, or you hear your parents talking to their friends about how they're really concerned about tariffs and what that's going to mean for them, because they keep hearing this is going to be really bad for the economy. And I'm no fan of tariffs, but I'm now glad that like everyone now thinks they're bad. There's that. I've been wanting everyone to hate tariffs forever. So, but it is telling that like this is, especially I think it's just really impacting people's 401ks. Like they're like, why has all my gains been wiped out since November? It's because of these bad tariffs. So I think, these sort of like fairly arcane things like the trade deficit, like which used to only like concern economists, really are weighing on people.
Yeah, it is so interesting, and I also think that there's some legit research backing up the idea that the way we interact with macroeconomic data is changing because of social media and so forth. Our friends at Morning Consult had a paper not so long ago alluding to the fact that your social network, the people in your social network will tell you something about the way you process information and the way that information is disseminated. And I do think that's so interesting. But Allison, you've in our statistics project that we published with Bloomberg Opinion this past week, where we looked at a series of metrics through which we could understand how well or poorly the Trump administration is ultimately doing at delivering on its promises. You looked at inequality, and you specifically looked at the housing market, right? So I would love if you would bring the housing market into this discussion that we're sort of having about the wealth effect here, because as you point out in your writing there, the housing is so important to wealth for the vast majority of Americans, right? It's only sort of rich Americans who are kind of overweight equities. Most people are overweight their home equity, right? So how are they thinking? How is like the typical American thinking about their wealth, the future of their wealth, the security of their wealth amid all of this macroeconomic uncertainty? And, could some of these concerns legitimately become a self-fulfilling prophecy, do you think, where people start thinking about the fact that their portfolio might go down, so they start spending less, yada, yada. Do you think that's a real concern?
Yeah, I mean, I think, so I did wealth inequality and just showed that so much of the narrowing and widening of wealth inequality comes down to how the housing market is doing relative to the stock market. But I don't want to undersell how important the stock market is to everyone. 60% of Americans do own stock. And as we're always told the stock market isn't the whole economy. It's a very important part of it. And even if you don't have a lot of equity holdings, I think people do see it trembling and get nervous. I mean, on the one hand, was it Scott Besson or Howard Lutnick? I can't remember which one this week made this sort of odd argument, like, well, the 10-year's down. And it's like, well, and that would be really good for housing, I guess. No, not really, but like it would be good for mortgage rates if it goes down a lot. But yeah, if we're in the middle of a recession and no one has a job and other forms of wealth, like it's not really that good for the housing market. So generally, I think we want prosperity, we want growth, and that's better for everyone, even if we do have wider inequality. And, I think to the extent that, the Trump administration sort of in a pickle, no matter how good their policy is that the housing market is just sort of wonky, just from the fact that rates were so low for so long and then are now higher. So it's going to be a challenge. And what I found is that the first Trump administration, inequality did narrow quite a bit because for whatever reason, low income housing did really well. And so if you owned a house near a low income person, you did have this big gain in wealth, which might be another reason why a lot of lower income people felt really good about the first Trump term.
Yeah, that's a really interesting point, and I will point out in the context of your discussion of 10-year yields, after the dust sort of settled, we do now have the yield on the 10-year Treasury note down to a meaningful degree. We were trading around 4.28% when the number came out, and we're now looking at something around 4.22%. So noteworthy, but again, this administration has said that bringing down the 10-year yield is a priority of theirs. I think the context really matters when you see the yield down, but you also see stock prices down. That should make you scratch your head a little bit when you see the yield down and you see housing stocks, like Lennar and so forth, something like a third off of their all-time highs. That should make you question if this is a productive drop in the 10-year Treasury yield or something entirely different. Jose Torres, I want to give you sort of the final word here, and I was hoping that you could flick the macroeconomic story ahead a month for us. We're looking ahead here. Next week we're going to get CPI. Could be a very important CPI. A month from now, we're going to get another one of these non-farm payrolls numbers, and this could be the one that really counts. This is going to be the one where we start to see what are the real effects of these government downsizing efforts. Is it trickling through to private sector hiring? Is it affecting contractors and so forth? So where should we really be focusing over the next 30 or so days?
Definitely on interest rates. A big development recently. Formerly, you saw when you had heightened tariff talk, you saw higher yields and a stronger dollar. Now you're seeing lower yields and a lighter dollar. And I think a big deal there is you're seeing lower growth expectations in the States, but also shorter term premiums because of the government spending reduction. So that's going to be a pivotal focus, I think, for all of us. CPI volatility could be quite elevated. In January, we got that rounded up to 0.5% month over month. That was quite startling. We could see another surprise to the upside in February. And I think the next jobs report that we get in April for this month, March, I think that it's going to come in below 100,000 because of the factors that you mentioned. And I think education and health services, also big fiscal stimulus and spending is a big driver into that sector. I think that sector is going to begin to cool off and has been comprising a lot of the job gains in the last few years.
All right. We'll stay tuned then. Thank you very much to Jose Torres, Interactive Brokers. Thank you to my colleague, Allison Schrager. And thank you to everybody who tuned in. I'm Jonathan Levin with Bloomberg Opinion. And please join us again for the next stat. We'll be back for CPI next week. See ya.